Good morning, and just want to double check. Can you guys hear me? Just want to make sure that it doesn't look like this mic's working. Okay, yeah, it's the mic coming through the laptop. All right, I've got to figure out what's going on with that mic. There's a better sound when I use that other mic, but it's not working. So we'll just use the laptop. I want to thank you everyone for signing in. This is the morning market review, and it is Monday, the 20th of February 2023. My name is Russell Shaw. I'm a senior market specialist at FXCM, and my email address is rshaw@fxcm.com. And I'm just going to go ahead and bring up our high risk investment warning. I'll keep this on screen for a few moments. And just going to bring up the market commentaries disclaimer as well. And here is our references, MarketScope 2.0 and TradingView.com. And let's start off with TradingView. I must confess, I'm finding the markets quite difficult to read at the moment. Not the individual charts so much, but the macroeconomic environment and how the market is reacting to the macroeconomic environment doesn't make sense to me. And what I want to show you guys, just to start off with, is the median inflation rate. Now, what the median inflation rate does, it measures the sticky inflation, and this is really the key driver of the market at the moment. Is that the inflation is sticky? Okay, the Fed is going to have to deal with that sticky inflation. And if the Fed is dealing with that sticky inflation, it means that it has to raise rates. And if it's raising rates, but it's going to affect the instruments that we trade as traders. Now, let's just show you the sticky inflation. So this is quite surprising to me. It was rolling over quite nicely, I felt, and then it's now jumped up, and we've got this red arrow here. Now, what we're taking a look at in the second chart is the real rate. I'm not looking at it in terms of candlesticks. I've just made it as a line chart, and it's a monthly line chart. And you can see that the correlation coefficient between the CPR, the median CPR, and the real rate actually a strong, robust 93%. So what does that mean for us as traders? It means that if we don't get this under control, the real rates have to come up. Well, it doesn't look like it's under control, so it means that real rates are probably getting primed for some sort of increase. And if they're getting primed for some sort of increase, well, that's going to affect the instruments. So that brings us to this chart over here, which is a little easier for us to make sense of because it's a weekly chart. And we've got the US dollar, and we've got the real rates now again underneath that. So instead of a line chart, and instead of looking at it on a monthly scale, we're looking at it on a weekly scale. And I just want to reiterate where we're going with the thesis here. The thesis here is very important. Follow it very carefully because it's going to make if this plays out how I think it's going to play out, it's making the market very difficult to read, because 93% correlation. We see that the median has ticked up. To keep that 93 correlation, it means the real rate has to tick up. Well, the real rate, the Bollinger's are starting to squeeze. Okay, the Bollinger's are already showing you, they saying we're getting ready to move. Okay, now the thing about Bollinger theory is that it doesn't tell you which way the direction of the volatility is going to go. It can either go up or it can go down. But okay, if the correlation coefficient on the monthly chart is anything to go by, well, then there is a very strong possibility that we see this explosion in volatility to the upside. Well, if there's an explosion in volatility to the upside, what's going to happen to the US dollar? Well, the US dollar has got also a pretty strong correlation coefficient with real rates. It's at 70%. So if the real rates explode upward, it probably brings the US dollar with it. Now that's completely antithetical to just what I was thinking a few weeks back. Okay, so we're going to take a look at the US dollar in a moment, but The fact of the matter is the US dollar has moved from the bearish channel into the neutral channel over here. And I just wonder if it manages to keep in that neutral channel and move into the bullish channel. And that's something we're going to have to watch very carefully. So the key here is the real rate is getting set to move. It looks like it's getting set to explode, to be quite honest. And what we're going to do is we'll take a look at the US dollar now on a technical basis. Now what you can see is that I've got a lower peak and a lower trough on the US dollar weekly chart. Now that lower peak, lower trough on a weekly chart suggests downtrend. The US dollar is trading down, but if we take a look at the last 3 weeks, the last 3 weeks have shown bounce. We've seen the US dollar moving up. Now ordinarily, I would suggest that this is a sort of bear market rally, some sort of dead cat. But I am nervous to suggest that because of what we've seen in the median inflation. The median inflation has ticked up. That has to be dealt with by the Fed. The Fed has to deal with that, because if it doesn't deal with that, it's going to lead to all sorts of misallocation of resources. The profit margins on companies are going to get severely hampered. The Fed needs to deal with this. And the fact of the matter is, if the Fed needs to deal with this, this means that the lower peak all of a sudden becomes very susceptible to being taken. So we're going to have to watch this carefully, right? So one way this may play out is we see it actually take out the lower peak. If it takes out the lower peak, then guess what? We don't have a lower peak anymore. We've got a higher peak. It means that we've just charted a higher peak. That effectively ends the downtrend. That means that we're in a new paradigm. That means that we've got a lot of work ahead of us to try and figure out what is going on. It's not an easy market. All of a sudden, the market's got exceptionally difficult for us to trade. The other way that this might pan out is we might get some sort of pullback like this. And if it does that, it's going to suck us in. We're all going to think that the greenback is actually starting to push back, and then it's going to make a higher trough, higher peak. If it does this, this is the most dangerous scenario, because it puts the greenback back into uptrend. If it puts the greenback back into uptrend, we've got to shift our mind. Then our mind is no longer about trading the dollar short, which we've been doing the whole year. Now it's all about thinking, well, can I possibly go short when we're in an uptrend, right? So the idea here is that the pull up, the tick up of that median inflation has all of a sudden thrown the economics into all sorts of confusion. What do I mean by that? Okay, what do I mean by that? Hey, Howard, morning to you. What do I mean? Let's take a look at TradingView again. And one of the most confusing charts out there is actually going to be NASDAQ to the real rate. So I'm just going to change this from US dollar. I'm going to bring this to NAS 100. Now the reason that we look at NAS 100 is because NAS 100 is supposedly very sensitive to interest rate movements. Okay, it's going to be very sensitive to interest rate movements. So we bring in the NAS 100. Okay, and the NAS 100 is sitting in the bullish area. Sitting in the bullish area on the weekly chart. Now that's strange. It's very strange because the real rate has started moving up. But I want to take a look at this in a little bit more detail. There is, I think, a lot happening on this NASDAQ that is in fact telling us, it's warning us to be careful. So we want to be very, very cognizant of the message that the chart is telling us. You can see that the correlation here has actually broken a bit. It's moved to minus 50%. It should be round about minus 80%, right? Between sort of minus 70, minus 80. It's gone to minus 50%. That's telling us that the NASDAQ's moving in an antithetical direction compared to the real rate. Now that's odd. Why would that possibly be taking place? And one of the reasons is perhaps the Nasdaq is mispriced. Now, perhaps, because I don't know, what I'm suggesting here is that the market is very difficult to read at the moment. The macroeconomics is are quite stifling at the moment compared to what's happening with what's happening in the stock market. Let's go down to the daily chart and just take a look at this on a daily basis. And here you can actually see something interesting. On the daily basis, the Nasdaq's actually starting to show some signs of cracking, hasn't it? It's moved from zone 1 into zone 2. Now, I want to go back to market scope, and I want to do the daily chart analysis on the Nasdaq. So let's just bring up Nasdaq 100. Okay, and let's make this. Let's take all of these out. All right. First of all, let's just examine the weekly. The weekly in of itself is very interesting. All right. So what we have here is going back 3 weeks. All right. What we have here is a long-bodied spinning top. This is a candle of uncertainty. Bulls try to take the Nasdaq higher. Bears try to take the Nasdaq lower. It closed well off the high, it closed well off the low. So a very uncertain candle here. We move now to 2 weeks ago. 2 weeks ago, well, this candle is completely within, let's call it inside week. It's inside the range of 3 weeks back. In other words, the bulls did not have the fortitude to take price above the previous week's high. The bears didn't have the strength to take it below the previous week's low. Uncertainty. So we've got 2 candles of uncertainty. We've got uncertainty over here. We've got uncertainty over here. We go to the 3rd week. Now we just go 1 week back. This is a very uncertain candle as well. It's inside an inside week. So inside, uncertain, uncertain spinning top. However, take a look at what happened last week. It hit the high. The bulls lose complete control. And it ends very, very low compared to the range. This is what we call a gravestone doji, okay, or pseudo gravestone doji. We go through to the daily chart, and the daily chart here shows. Let's put in some peaks and troughs. We put in a peak, right? We put in a trough. All right. Now, if we use those as references, we've got a lower peak here. Okay. So we've got the lower peak here. And if we've got the lower peak is insinuating potential weakness. Now, the saving grace is what's going to happen here. Okay. Is this a higher trough? I'm nervous to call it. I'm nervous, and I don't like predicting any which way, but I'm nervous to say that the higher troughs here. Why am I nervous to say that? Because we just have to go back to this chart here, and you can see that it's fallen from zone 1 into zone 2. And you know what? It's fallen just as the real rate started moving, into zone 1. So you can see that there is some uncertainty. Everybody's saying that the stock markets are misbehaving, and I don't think they're misbehaving. I think they're battling. They're battling to go higher, and as soon as you're battling to go higher, well, that's called resistance. That means that there's a whole lot of sellers just sitting right above where the market is right now. Let's take a look at the DAX very quickly. All right, the DAX is looking better than the Nasdaq. That makes sense. It's less sensitive to rates than the Nasdaq is. The Nasdaq is more sensitive to interest rates, and we can look at that tomorrow. I'll do a time value of money session tomorrow, and we can look at the formula there. So do a little bit of mathematics tomorrow. It is in zone 1, as is the real rate. However, I would suggest that the candlesticks here are starting to look very small in terms of the bodies. The real bodies have started to look quite small. So if we go back to our market scope and we bring up DAX, okay, and let's go through to the weekly chart here. So just a couple of weeks ago, we were taking a look at this head and shoulders, which I think is actually looking, very sort of healthy. But again, the macroeconomics, we don't want to look at the technicals. We want to take a look at the technicals with the fundamentals. That macroeconomic environment, that tick up inflation, that's now thrown a complete spanner in the works. And the fact of the matter is, even on the weekly, we've got this resistance area right here that we're fighting. We want to see if we're able to overcome that. And I would suggest that the higher rates go, the harder it's going to be to fight. And what we're going to do is we're going to watch this resistance area right here. So you can see that there's a resistance area right above where we're sitting on the DAX. So even though it's sitting in zone 1, I would suggest that caution is the order of the day. Why is caution the order of the day? Because rate hikes are the order of the day. Why are rate hikes the order of the day? Because sticky inflation is the order of the day. And those are all very conflicting variables when we take a look where we positioned in the zones. And we positioned in zone 1, but we've got all of this overhang. And I would suggest that we just need to get some sort of clarity here. Don't go rushing in. If you are going to trade, make sure that you've got a stop loss. Make sure that you're using strict risk management guidelines and money management guidelines. And that's, I think, going to help us as we navigate through this uncertain period. All right, that's where we're going to leave it for this morning. I want to thank everyone for joining. Tomorrow, we'll do a time value of money calculation. So if you're interested in that, please join me. Thanks very much, and have a good day and a good evening ahead. Cheers, guys.